So as we were preparing for our panel today, we started the conversation just saying, what is an esoteric asset? Because it seems to be viewed differently depending on who you're speaking to in the market. So I'm going to ask Joe first. What do you think we mean in terms of esoteric asset classes?
We all disagreed on what really was esoteric, and maybe the best agreement was that there might not be a lot of things that are truly esoteric. In fact, when you look across both the U.S. and the European markets, there are a lot of things that are non-standard, or as I like to call them, non-traditional. But while we use the term esoteric to define things that broadly are outside of the scope of typical consumer and commercial assets, auto, credit cards, a lot of the mortgage-related product, many people find that the asset classes and the structures that we're looking at still tend to be fairly standardized or derivatives of things that we're used to seeing. So there isn't one definition, as we would all recognize in this room. As a result of that, it's very hard to put a single definition to what is esoteric. So we put together a list of different asset classes across the U.S. and Europe that people would typically define as esoteric or non-traditional, and more times than not, they tend to be things that we're used to seeing. It's just a matter of a different type of format. So, taking some of them off the top, transportation assets is an asset class that is predominantly seen in the U.S. Away from autos, but while they may be heavy equipment such as rolling stock, aircraft, shipping-related assets. They are asset classes that we've seen for 20 years. So while they're non-traditional and more illiquid, if we want to even define them as that, they are asset classes that many people tend to know, they just don't see as often. Marketplace lending is a great one, even though it tends to be a catch-all for a lot of different asset classes that we look at. Having really grown out of the U.S., seeing a lot of what we're defining now as fintech, we're talking about small business loans. We're talking about a lot of consumer unsecured related assets now, home improvement and mortgage related assets. So really we're talking again about asset classes that have a lot of the same features as things that every investor, issuer, service provider in this room may know in another format. We're just now seeing that it has characteristics to it, whether it's the need to have additional structural reinforcements because the issuers or the originators are smaller, less capital worthy or less capital intensive, or are assets that are built and created and then sold to third party. And you can keep working down the list. Handset transactions, when we were first developing those in the U.S. as well as Europe, were seen as fairly non-standard. These are new and emerging assets. We're not sure exactly what to do with them, but again, everyone in this room that's taken out one of these loans knows that they have a 24-month unsecured installment loan to buy their handset, and there may be features to it that allow them to sell these back or trade them in a certain period of time. But functionally, it's not very different than what they're used to dealing with. The renewable space, again, a lot of the same characteristics. So I'm not going to bore people going through a full list, and certainly there's a lot of other areas that we can talk about, and we're happy to take questions on. But I think functionally what we're really dealing with here is a universe of asset classes where the features tend to be consistent, tend to be things that everyone who's put their credit hats on in the room have seen. They may have different structural features. They may have requirements for complexity, or there may be complexity within the structures as a result of certain needs of the asset themselves, but they're not as wholesale and new as you'd love them to be. And from an investor standpoint, we thrive on new and interesting. And while we obviously need to figure out whether we like the credit dynamics of those, we're always looking for something that's going to make it interesting to us and obviously get us paid. But it's really more about making sure that we understand the features of those and how we can make them consistent with other things, which we can pull that thread through in most of the things that we would define as esoteric in Europe as well as in the United States.
Great, thanks, Joe. So as we're going through the list, I mean, I think one thing that's jumps out for me is that a lot of these assets end up being placed in the U.S., and we have a much broader market in the U.S. than what we've seen in Europe. So, Miles, if you could touch on, some of the deals that we've seen in Europe that we would consider more esoteric, and what you're seeing.
Yeah, sure. I think, following on from what Joe was saying, the one thing is clear that this panel's on esoteric investments. I think if you said that you were going to go and look at esoteric only, that's deemed to be risky. Non-traditional ABS seems to be less risky. So the idea of thinking non-traditional rather than esoteric, maybe that's a kind of sexier way of looking at it. If you look in Europe, you don't have the same kind of breadth of deals that actually have got done in terms of non-traditional or esoteric. And we did a bit of a trawl through in terms of what's happened in the European space. We've seen 2 esoteric deals, non-traditional marketplace transactions for Funding Circle and Zopa in the marketplace space, much less than you've got in the US. Again, looking at non-traditional, non-bank consumer has been a big thing across Europe, but there's still only 3 or 4 deals that you've got to think about. You've got the BNP's Aurora's transaction, Uday, the credit card company, Wizink, Delamar, the Tesco credit card businesses. Those, I'd put them more in the non-traditional ABS as opposed to esoteric. Next thing in Europe, mortgages. Now, mortgages, that's a traditional ABS, but non-standard mortgages, buy-to-let, non-conforming, second lien, for example. You've seen an increasing number of those over the last 2 to 3 years. And those started off being in the Netherlands. We've got a lot in the UK, seeing some activity out of Sweden. Those kind of transactions, I would say, are anchored on asset classes that people understand, but they have a tweak to them, which means that you can hopefully kind of get paid from an investment point of view for doing your work to understand them, but at least you're using the broad base of kind of a knowledge base that you've worked on. Other deals, and I think we're going to talk about this later, is UK student loans. There was a big transaction that actually Julian worked on, which is the UK government student loan. Again, only one of those post-crisis. Trade finance. Got lots of talks about trade finance transactions, only seen really one publicly placed, just the Trafigura transaction. So when we look at non-traditional, I think going on from what Joe was saying, these are non-traditional but based on the modelling techniques that you've learned on consumer credit and mortgage credit and leveraged loan credit, for example, from other asset classes, and then jumping on top of those to be able to understand the tweak.
Yeah, it's interesting. I think you may have answered in part some of my next question is just in terms of if you're looking at the U.S. versus Europe and what we define as esoteric or non-traditional, which I think is a good way, we were talking about that earlier, of talking about it, does it change as we, move from the U.S. to Europe in terms of what we mean by esoteric? So I don't know if there's anything you gentlemen wanted to add in that regard, just in terms of what that means here. It's a question of there haven't been as many, but is it esoteric? All right, so, okay.
I think one of the things we discussed before the panel was that possibly there's a life cycle that asset classes go through. So they begin as the sort of credit asset or credit exposure which banks lend on balance sheet, perhaps because they find a niche market for themselves. And then it might become an asset-backed commercial paper transaction. Later on, it might be seen as a sort of single agency deal, and then ultimately becomes more mainstream. And it's not, because I've almost always worked on esoteric deals myself. I mean, I haven't necessarily seen that process followed through into the mainstream market, but I think there are others on the panel that can point to that process.
Yeah, I think that's definitely been the case in the U.S. in terms of some of the deals that we've seen and, following, here as well. we recently rated the S-Bolt transaction for funding circles. So that was a new, we've been very active in the marketplace space in the US, but it was new for us to do that over here. So we're very excited to extend that here. So I mean, it's a question of people getting more comfortable over time. And sometimes it's not related to the credit itself, as we discussed. So,
and I think you had mentioned structures versus assets,
Right.
and that's an important point because, especially with the moves around STS, trying to create greater transparency and standardization in Europe, in some ways, you're removing some of the esoteric out of this. In the U.S., we continue to see a greater development of not bespoke transactions, but certainly taking assets and developing structures that suit the asset. And we were having a discussion prior to this panel about, in many cases, the need to have that structure. And when we look at it, it may seem like complexity for people that are not sitting in this room, but in many respects, it's addressing discrete risks, very unique risks that are specific to an asset. And multiple analogies were used, but ultimately the idea here is to reduce risk through structure, which creates complexity. So when we think of ways we define this, there is an argument to be made that a structure becomes more esoteric, but creating structures that have backup servicers, that have greater arrangements through the structure that provide protections to investors, then ultimately we find ourselves in a position where we are protecting the investor. I mean, one role we play as an SPV manager is providing those backups within transactions. And in many respects, we find that certain private investors like our role as a private investor in some of the things we're doing. Do we create complexity? We'd like not to think so, but we're structured finance people. So the things we're doing don't seem complex to us, but might seem to a regulator or another third party. So how we define esoteric in that construct in a U.S. transaction or a private European deal may be different than something that would come to the institutional markets.
Very good point. So just skipping over to the regulatory aspect, I was going to ask Julian to help us out here, just to start off, and perhaps Richard can join in terms of some of the regulatories we've seen to new or emerging asset classes, and then when we're looking at Europe specifically, how the number of jurisdictions may add to that complexity as well.
Thanks, Rosemary. Yeah, I guess in terms of continuing the US-Europe theme, I think that's very fair to say that the number of different jurisdictions across Europe means that it's much more complicated from a legal perspective, to put together cross-border securitization in Europe than obviously looking at a deal that's across the United States or drawing assets from across the US. And I think that really then feeds into the fact that you're not seeing in the sort of deals that Giles mentioned there, any real pan-European securitizations in the public space. We're very used to seeing it on trade receivables deals. Those are largely private deals in Europe. We've looked at it in other contexts like marketplace lending, for example. But it really is a process of analysing, understanding, looking at the legal risks in each of those jurisdictions, and they can be quite different. There are areas, of course, where there are similarities, particularly across the European Union. There are laws that are either directly effective or derived from European Union laws, so there can be commonality. And indeed, across the civil law jurisdictions, there's similar founding principles as well. But nonetheless, it's an exercise in review in each of those jurisdictions, and that complicates matters from a legal perspective. There's obviously conformity, a lot of it sort of on the liability side that's been driven by the European Commission in terms of the Capital Markets Union and the securitization regulations, market abuse rules, prospectus directive, which is all can be helpful for transactions. But ultimately, as Joe was saying, I'm not sure that many of the esoteric or non-traditional assets that people have been talking about will really fall within the STS criteria and so won't necessarily benefit from those arrangements. But fundamentally, the cornerstones of what we're talking about on an asset-backed deal, origination of assets, asset transfer, security, insolvency regimes. These are all going to be specific to each jurisdiction, and that will need to be looked at in each case. And I think that maybe I'm looking at this more from a glass half empty perspective, and I think Richard perhaps saw some opportunities in this regard, perhaps more from a glass half full perspective. Richard.
Well, I'll try and be optimistic. Yeah, I was thinking about the nature of this panel, and it's sort of, what is it supposed to mean? What's the message? And what kept popping back into my head is that maybe we're just a panel that no other panel would accept. So, but that's it's a bit like the Groucho Marx. No, I don't want to be a member of any club that would have me as a member. So, I think there is some cause for optimism. On the the general view is that we make an unfavourable comparison with the US, which is not just a single economy but a single jurisdiction as well. And ostensibly most people treat the EEA as a single economic bloc, certainly a single trading bloc, as the British people are only too well aware. But it's not a single jurisdiction. So there are tremendous differences in, first of all, in insolvency laws and also in tax as you move money or assets across borders, even in the European Union. I would say that I think the European Union insolvency regulation is of assistance, though. And if we look at the sort of protections certainly that I saw the rating agencies push for in the 1990s with regard to having a spy in the cab and some degree of negative control in favour of debt holders in whole business securitisations. Some of those techniques can be used to more firmly establish the centre of main interest of the issuer as also the owner of the assets. So it is possible to overcome more challenging insolvency treatment on default in structures. But also I think where we turn things on their head, I guess, is that I've looked at a lot of transactions and completed a number of transactions where the assets don't really have a jurisdiction. So I think one of the benefits of using assets like container vessels or aircraft or even rolling stock in a transaction is that they won't necessarily be caught up in the insolvency of an entity in any one particular jurisdiction. They move around. But therefore, what you do need is a system, an internationally recognized system of registration for those assets, together with registration of security and knowledge that those security interests will be enforced in jurisdiction where they're registered. Obviously, that's best established in the shipping space, where there are a number of international registers, including a couple of very successful registers in the European Union. And then it becomes a matter of whether there's a judiciary in that jurisdiction which has the knowledge and experience to enforce security in a swift and efficient manner. And on the United Arab Shipping Company transaction that we worked on a couple of years ago, the rating agencies asked us to prepare a timeline for enforcement of security in a number of jurisdictions where generally creditors know it's a good place to arrest a vessel. And we did quite a lot of analysis at that level of detail. Now, with regard to aircraft, you've also got the Cape Town Convention and wide recognition of the ADIRA, which is kind of a security power of attorney on steroids, which does mean that you can enforce your security and force a sell through pretty quickly. The benefit with aircraft is that there is a much more active and liquid market for aircraft than there is for ocean-going vessels, which tend to be much more disparate in their categorization. At the moment, of course, in Europe, there is no system of registration for rolling stock, but we have an awful lot of borders, and we're moving rolling stock from jurisdictions with very different insolvency regimes, so from Luxembourg to France, for example. Even then, we're talking about a different sort of kettle of fish. So there's been a lot of work done recently by what's called the Rail Working Group, which is introducing the Luxembourg Protocol to the Cape Town Convention. extending essentially the same rules for registration of rolling stock and registration of security interests as apply currently to aircraft for signatories to the Cape Town Convention. So we're hoping is that there's opportunity in that space as the European continent finds itself desperately short of adequate rolling stock at the moment, and a number of governments that are reluctant to finance the size of the fleets and the national pools.
Thank you. So, Ankar, in terms of other challenges in the EU, in terms of seeing more publicly issued securitizations, is there anything particular that you wanted to focus on there?
Sure. I think some of the things you mentioned, sort of in terms of the geographical differences leading to sort of, comparable to the US, you're fractioning into getting a particular size in UK alone and in Spain alone and so on. So, for example, lenders in the Nordics who tend to be across Finland and Sweden, it's two different currencies, and so the transaction and two different regulatory and bankruptcy regimes. So in that sense, can you combine the assets into one vehicle, issue one structure? It becomes more challenging. And hence, that's one big factor in Europe, especially in public deals. I think the second thing to mention is sort of a lot of the solvency and other regulatory constraints leading to certain investors types preferring whole loans versus tranched exposures. And that is, you've seen that in the Dutch mortgage space, you've seen that in certain other asset classes as well. Hence, so for example, at Jefferies, introduced a pass-through note structure, which converted loans, keeping the whole loan exposure, but into a note format. So again, trying to meet some regulatory requirements of investors to be able to invest in an ISIN as opposed to invest in loans. But you've seen that all of these things require a certain minimum size, commonality of currency, and regulatory legal framework. And that's been a relatively decent hurdle in Europe so far. I think the other bit to mention is sort of the rating agency requirements. Again, in a public deal, you need two rating agencies in Europe, having a rating. For some of these lenders with those kind of size constraints or still going through the ramp-up stage, it's a bit more time and cost effort involved, and the whole process extends by a little bit. And again, that's led to certain sort of shyness from some of the originators, shying away from trying to get a rated deal out. And hence, the deals that have been done away from the ZOPAs and funding circles, for example, in the marketplace space, have tended to be more private transactions. So that's where we are in Europe, unfortunately. There's still a bit more in the private space, so hopefully that does come out into the public space in the next 12 to 18 months. I think as was mentioned earlier, that there is a flow of how these assets go from the private space into the public space, but it just takes a bit longer time to market, so to say, in Europe.
And even the marketplace space in the U.S., it even took time for that really to develop, just trying to sort out how to address all of the risks associated with that and get people comfortable, and it's sort of still developing, I guess that's how I would term it. Great. So, Joe, when you're looking at different deals, how do you view jurisdiction as a variable in assessing the risk associated with these assets?
Oh, it's a key jurisdiction is a key issue whenever we're looking at transactions. We are an active participant in the European market, so it is an area that we look pretty closely at, and we've addressed a number of the issues whenever we think about how do you aggregate assets in a meaningful way in Europe? How do you bring them across jurisdictions to put them into a legal structure that is friendly to us as a structured investor? But there are a lot of even more fundamental things. How do local laws and the effect on collateral occur? How do we think about servicing and collections and the origination function that would arise as a result of those? How do we view the differences from country to country? Very important, the points that have been raised around Europe not being a single market, even with the EU attempting to unify a lot of the standards, just the differences whenever we look at a UK transaction versus a French transaction, just on how you view the consumer. GDPR now is unifying a lot of the privacy regulations, obviously from a very conservative perspective, but more fundamentally, we know when we operate in certain places, we have a right to certain components of a consumer's information. In other places, there's no way we would be able to receive that, and that can change the nature of the transaction that we're looking at. All of these things have an impact at a micro level, but they even at a macro level. When we think of what are called the periphery countries in the U.S., I don't even know what they're calling them now in Europe with all the political events that have been happening recently. But the political risk that's occurring, how do we think about the risks that are still that still have occurred in recent years that are going on? How do we view situations like Brexit? Does it remain an opportunity or a risk to us as an investor? So all of these factors do play a very significant role. Obviously, risk introduces price, which means that we can find a way to get paid in many of these circumstances. But there are issues or variables that have to be factored in.
And Miles, is there anything you wanted to add in terms of what you're seeing?
Yeah, I mean, I think the comment I would make on kind of where we stand at the moment is that certainly from a NatWest point of view, we're pretty bullish about the way the European market looks despite the headwinds that we've got. The reality is there is more and more money going into alternative assets. There's more and more money that's looking for that non-traditional ABS that pays you something a little different or gives you something lower down the capital stack, etc. So with that wall of money that is out there and it's still looking for assets, we look at kind of the opportunities that come through us. And there's that genesis that you start off with a repo transaction and then it becomes a private transaction, then, well, retained, repo, private, public. You can see that that's what happened with the Italian non-performing loan market at the back end of last year. The banks were heavily involved in repo financing NPLs to start with. We were one of the big banks involved in the UniCredit GACS placement. If you then look through what's happening with the European market as far as fintech is concerned, you've got fintech with new lenders starting up. Those new lenders are starting in consumer. They're starting in either non-bank bases or in challenger bank bases. They're getting bigger and they're doing more product. Again, it's not esoteric. I would still call it non-traditional ABS.
We're going to change the title of our panel by the end.
So. If you look at names like in the UK, you've got people like Atom Bank, for example, Sainsbury's, Shawbrook, for example, increasing market presence, second lien market, Optimum, Belmont Green, for example. There is a lot more product that's coming out. And again, in consumer financing, SME financing, there's more variety coming out. We announced a transaction for a Spanish lender last week called Bespoke Capital. It's a Spanish non-traditional financing company. You're seeing more of these types of deals coming out. So yes, there are headwinds, but there's more money chasing those. There's more appetite for risk across the capital stack in the right places. So certainly, we're feeling quite good about the market at the moment.
That's good to hear. I didn't want to be focusing too much on challenges as I ask every question. So Richard, I know you spoke a little bit about rolling stock before in terms of some of the initiatives that have occurred in terms of addressing that market. I wanted to see maybe if you could touch on the EETCs in terms of, is there a way to, do you ever think that you would see a version of the U.S. EETC market in Europe like we do in the U.S.?
Oh, I certainly hope so. I mean, but I mean, yeah. I mean, it is. It's interesting. This huge dichotomy between the size of the market and in the U.S. and the market in Europe. So I mean, I think first of all, and this only I only understood this relatively recently. In America, they make a distinction between EETC or enhanced equipment trust certificate transactions on the one hand, and asset-backed securities on the other. Essentially, they're the same investment, but just that the issuer is different. So, whereas an asset-backed securities transaction, typically the issuer will be a leasing company, which leases its aircraft to a variety of airlines. In a EETC transaction, the issuer will be essentially the operator of the aircraft, so an airline. In Europe to date, we've only seen the sort of the ABS style transactions. So the deals a long time ago now for Guinness Peak Aviation, the Alps, the aircraft lease portfolio, securitization transactions. In terms, and I guess in the rolling stock space, the transactions in the UK for Angel Trains, and then when after it became Alpha Trains, there were a couple of transactions recently in Germany for Alpha. But those are leasing companies. Whereas in the US, the double ETC market size is about 6.6 billion or something. So, it's a decent sized market, and increasingly, therefore, I'm beginning to wonder why airline operators outside the US are not looking to a double ETC style market as a source of funding, particularly as the bank sources of funding have dried up. And that's certainly the case in the maritime sector that we've looked at. So I think there's enormous amount of potential there. I think also if I look at the maritime transactions that we've been involved in, where they've been dubbed EMTCs, or Enhanced Maritime Trust Certificate transactions, the cornerstone investors and the subscribers of about 60 to 70% of the paper overall were US investors who traditionally have invested in double ETCs. And one aspect of the double ETCs market success is that you have major investors, which are relatively small in number, have now got, they're overexposed to certain credits. And they're looking to diversify that exposure. And one way they might do that is to look at maritime assets rather than aviation assets, if they're prepared to do the work, and they get the benefit of being one of the early movers if they do that. But it's also looking at aviation operators outside the United States. So I think there's every reason for the market to grow, particularly as I said, that you can register an aircraft anywhere where there's an operator, and you can, in theoretically, you can arrest an aircraft anywhere where the jurisdiction is a signatory to the Cape Town Convention. So it should be an attractive way for US investors to diversify. I also, actually, once we started to deal with investors, we realized that alongside, in the maritime space, for example, alongside the traditional, mostly German bank lenders in that area, they very often brought along pension funds and insurance companies as co-investors in those transactions with them. And now those investors are now looking for replacement for those assets. So I think there should also be demand from investors in Europe for transport assets as well. Again, one of the basic aspects of the attraction to US investors in the transport space is that rolling stock and containers and planes and vessels are always valued in dollars. So they diversify their credit exposure, but without incurring currency exposure. So it should grow. I mean, it's just, the frustration is that it hasn't to date.
Good. I like we're getting an optimistic theme going here now. So, just switching gears for a moment, Ankar, I'm going to ask you to touch on, I know recently the Funding Circle S-Bolt deal was done, and just looking at the market, the European market for marketplace transactions, and specialty lenders, what are you seeing, and where do you expect it to go?
Sure, and I think we touched on some of the themes earlier, but the main drivers here tended to be more US driven. So the US led the way, like we discussed in this space first. You had more sponsors. The sponsors of these platforms tended to be US money, whether it's private equity style sponsors or whether it's pure marketplace originators. The scalability was there first in the US, and they were brought to markets first. In Europe, I think we're still seeing the theme that some of these guys have done private transactions, apart from the Zopa and Funding Circle, larger established players in the UK. On the continent, there's been a few private transactions. There's been quite a few whole loan transactions where you have investors providing money and signing up. So institutional investors signing up to the platforms as a direct lender into the platform. and taking loans from those platforms. We've seen some pass-through note-like structures as well, so converting the loan exposure untranched into notes, into ISINs and securities. And I think what we've seen, if you include the broader definition of specialty finance, which is, I think, what Miles mentioned earlier, which is non-traditional and which includes, for example, non-conforming mortgages, and includes somebody like a premium credit, insurance, consumer exposure, but in the insurance space, insurance premiums, or you include slightly broader definition than just pure marketplace or fintech platforms, then you tend to see that there's a lot of transactions in the private stage, which have been with banks providing balance sheet, or even directly asset managers and institutional investors providing private financings to them. So it's unrated, it's potentially still in the ramp up or the revolving phase, and sort of will come to a public markets distribution once you have reached sort of the 150 million or thereabouts equivalent in euros size.
They just need to grow up. They need to grow into it, essentially, to
Absolutely.
some extent.
And I think the other big difference was, one of the factors was the risk retention rules, which came again into place in the US a bit later, a few years later than Europe. And that also sort of, with other things coming into place nicely, the lack of risk retention rules at the time in the US helped to get some of these deals off the ground and avoided some of the delays and conversations that have happened in Europe.
I think it's fair to say now in Europe we have structures that people are comfortable with in terms of risk retention in those sorts of transactions. But yeah, no, fair point.
So just going to switch gears again a little bit, because I wanted to make sure that Julian has some time to talk to us a bit about the UK student loan transaction.
Yep. Have we got 5 minutes?
Yeah.
Okay, 5 minutes. I think I was working on the deal since 2014, so 5 minutes to cover it.
We'll continue after the panel.
As Miles mentioned, I mean, this is the deal that that closed late last year. We acted for the UK government on this transaction. There have historically in Europe been other student loan securitizations. I think those have all been deals where the collateral was originated by the UK government, but the securitization was then conducted by the acquirer of those assets. Contrast with the US market, where student loans securitizations are a much more common feature, and I guess that's just a function of how higher education is funded in Europe versus how it's funded in the States. I think a couple of big differences with this transaction versus the US deals and actually the earlier UK student loan securitizations are, number one, this was a sale and securitization by the UK government, so there's no third party that then conducted the securitization. So the UK government was looking to make sure it captured all the benefits of the financing in the sale, rather than allowing a third party to do that. The other key difference, and I think this is a really significant difference, is that the assets were income contingent repayment loans. So they were not scheduled repayment loans like in the US and like in the earlier versions of sales in the UK. And the borrower does not repay the loan unless they have an earning, their earnings are above a certain threshold. So they're quite difficult to model and understand, and there's actually a lot of other features that are relevant to them, macroeconomic features that are relevant to the performance of the loans and the repayment profile. So I think that was something for the rating agencies and investors to get their head around. And I guess the other feature was that this was entirely off balance sheet for the UK government. The idea was to transfer the risk in the portfolio to private sector investors through the securitization. So we had a sell down of the entire capital structure in the transaction. Obviously it has to be compliant with the European risk retention rules, and so there was a random selection that was retained. But the entire capital structure in the transaction was sold down. And there's a host of other features that that are interesting in terms of collections being made through the UK tax system, and therefore servicing remaining with the UK, essentially the UK government, which you could see as a potentially benefit for investors, but which distinguish it from other sorts of transactions. So yeah, I mean it's interesting, to actually talk about something that certainly I think fits into the esoteric space, both in terms of asset class and and the way in which the capital structure was placed out to investors, which actually completed in the public markets.
Interesting. I wonder you had to work on it for so long, right?
Yeah, well, exactly.
So,
yeah.
Okay, great. I think we only have a few minutes left, but I wanted to go back to Joe, just in terms of looking at, for investors, where do you think that you could find yield now?
Good luck. No, just kidding. No, I mean, all these asset classes do offer yield on a relative basis, and I think that's the most important thing, right? Because all of us in the alternative asset space love to go out and say that we're going to generate extremely high returns for our investors because that's our targets. It's a matter of being able to find high relative returns. It's being able to generate those outsized returns and finding ways to do it on a good risk-adjusted basis. So, the couple of areas that are, I think, the most obvious, aviation among the transportation assets has historically offered very good yield. I think a lot of that is that there are still many investors that have good institutional memories, which say that there have been issues in the past. Many still haven't embraced the new structures and gotten comfortable with this version, whether that's 3.0 or 4.0, depending upon who you ask, of aviation ABS. So there is still greater yield in this asset class versus others, even as you've continued to see them tighten. Whole business securitization in the U.S. is an asset class that has offered good risk-adjusted returns. Some interesting names, interesting structures. Again, you're being paid for structure, being able to do so. We continue to like renewable assets. We love PACE, and that's an area institutionally that we're heavily involved in. And when you look at the credit profile, look at the rated bonds and where you're able to get paid, we're not a AAA buyer, AA buyer, but at the same time, when you look at the way that you're able to get paid, the tenor of the assets you're able to buy, you're getting paid on a credit spread basis as well as on a going out the yield curve, if you believe there's much to a yield curve anymore, then you can get paid there. So, I think the general theme is most of the asset classes that we're talking about today, whether they're emerging or if they've been in place for a long time, are going to pay for the complex structure of a UK student loan or a European marketplace transaction. You're going to get paid for a US complex structure that's in place, even if it's addresses the risks that you're talking about. So you can find ways to get paid in these asset classes, but we recognize that that's going to come with work. And because there is a lack of these transactions, the other challenge that many of us face is that there tend to be very high subscription levels on them. So just as often as you see them in the broader markets, we look for partners. Many of the other investors I know look for partners where we have an opportunity to work directly with banks, being able to work closely on transactions, to either be involved in bespoke deals where we're buying private tranches of private deals, or we're getting involved with issuers early where we have an opportunity to get paid as a result of that. That's one area we hadn't talked heavily about today, but when we think about esoteric opportunities, one of them around structure tends to be getting involved early when an issuer is still developing, so that there is a chance to get paid a little bit more before they're through the full product cycle and they're a well-known name, they're very liquid, and obviously then you see spreads and all-in pricing come in quite substantially.
And just last question in terms of, are there, and I'll throw this out to the group, anything in terms of new asset classes or unique structures that investors should watch out for in the near term? Or I know it's kind of a tricky one because you may not be able to speak about them as much if it's not out there yet, but anything in particular that we haven't talked about that you think investors should take a look out for?
I would say there's a few products which sort of, call it European deleveraging, regulatory pressure, etc., but also diversification from, bank balance sheets. In general, you've seen asset classes like trade receivables, supply chain finance, inventory securitizations, bridging and development finance assets, the private version of the UK government's Help to Buy scheme, shared equity mortgages. You've seen these kind of assets being funded and on a private basis, typically by institutional investors. And that's, I think, something to look at, those kind of asset classes which don't tick the regulatory box for institutions like banks, would be one place to look at.
I'd add to that, and actually one thing that you touched on earlier is this development of the whole loan market. One thing is very clear that if you look at whole loan investors in the Dutch market, has made a material difference to the way that the Dutch market operates. Pension funds and insurance companies becoming direct lenders into what have been traditional asset classes for banks, whether they be consumers or mortgages, consumer assets or mortgages. Certainly we anticipate to see a lot more of that. Ultimately, if you're looking for a source of high volume product at very low risk and a kind of limited loss given defaults, actually something like mortgages is an appealing asset class. We've seen that in the Netherlands, clearly in size. In the UK, you've seen it in non-standard mortgages. It's happening in Sweden. We certainly see that more in consumer assets in the Netherlands as well, buy-to-let in the Netherlands and the UK. So certainly pure whole loan structures working alongside securitisation they work in parallel.
Okay.
We're seeing a lot more of that.
Terrific. So please join me in thanking all the panelists for participating today, and thank you.